Piedmont Realty Trust just threw a massive curveball at the commercial real estate bears. I mean, they hiked their full-year guidance for 2026 by a solid 200 basis points.
Right. They're essentially defying that whole doom loop narrative we keep hearing about. The headline numbers are honestly critical for anyone watching this sector right now.
Yeah, exactly. So let's just get right into this Q2 print for Piedmont, ticker symbol PDM. Core FFO came in at 38 cents per diluted share.
And just as a quick reminder, core FFO funds from operations is basically the true cash-generating metric here, since it strips out all that depreciation noise.
Right. Total revenues hit $144.1 million, and they actually managed to narrow their net loss to 9 cents a share.
They are definitely tightening the bottom line, which is not easy in an environment where capital is this expensive. But, the rearview mirror isn't really what's driving the stock for retail investors today.
No, it's all about the forward look. Because for the second consecutive quarter, management is raising its full-year outlook.
Yeah, they bumped that core FFO guidance up to a range of $1.50 to $1.55 per share.
Which is huge. But even more importantly, they are projecting a 5 to 8% growth range for same-store net operating income, or NOI.
You really do not raise your same-store NOI guidance halfway through the year unless you have, intense visibility into your underlying cash flows.
Right, because that metric tracks properties they've owned for over a year, right?
Exactly. It isolates the true operational strength from any recent acquisition noise. Management is basically telling the market, hey, we know exactly where our revenue is coming from for the next 6 months.
I really want to dig into the mechanics of that confidence, though. It's super easy to just look at a raised outlook and assume everything is perfectly fine.
Oh, for sure. You have to look under the hood at the actual leasing momentum to see if it's sustainable.
Yeah, and in the second quarter alone, Piedmont executed nearly 460,000 square feet of leasing.
Which is just a staggering volume. But honestly, it's the margins attached to that volume that really stand out to me.
Wait, really? The margins are that good?
Yeah, they achieved their highest quarterly average net effective rent in the company's entire history. It hit $25.56 per square foot.
Oh, wow. And just to put a finer point on that for you listening, when we say net effective rent, we are talking about the actual economic value of the lease to the landlord.
Right. It's what is left over after you strip out all those heavy concessions.
Exactly. Like the tenant improvement allowances to build out the office or, periods of free rent.
Hitting a historic high there means Piedmont isn't just slashing prices to get bodies in the building. They're not giving away the farm.
Right. They're actually signing highly profitable paper.
And that profitability becomes even more glaring when you dissect their leasing spreads. Basically, the rent on a new lease compared to the old lease for that exact same physical space.
Let's talk about those spreads, because there's a big divergence there. On a cash basis, their rental rate growth was 14%.
Which is solid on its own.
It is, but on an accrual basis, it skyrocketed to over 32%.
Yeah, a spread that wide definitely requires some parsing. It usually indicates some pretty aggressive structural mechanisms built into the contracts.
So break that down for us. Why is the accrual jump so much higher than the cash bump?
Well, it comes down to the quirks of commercial real estate accounting. The cash spread is literal. It's just the cash collected in year one of the new lease versus the final year of the old one.
Okay, simple enough.
But accrual accounting straight lines the rent over the entire life of the lease.
Right, so it averages it out.
Exactly. So if a corporate tenant signs, say, a 10-year lease with massive annual rent escalations baked into years 7, 8, and 9...
Accrual accounting takes all those future increases and records them today.
You got it. So a 32% accrual spread tells you management is locking in some incredibly aggressive rent bumps on the back end of these deals.
So they are heavily backloading the profitability, but they are still capturing immediate upside, right? I mean, they posted a 9% same-store NOI cash growth this quarter.
Yeah, and if you read through the filing, a massive driver of that immediate cash growth is the burn-off of free rent abatements.
Okay, I love this part, because when you sign a premier corporate tenant, giving them 3 to 6 months of free rent up front is just standard practice.
Right. Oh, absolutely. You have to incentivize the move somehow.
Right. And while that free rent period is active, your cash NOI looks artificially depressed.
Exactly. But once the calendar flips and that period burns off, the cash floodgates basically open.
I was thinking about this earlier, and I came up with an analogy. It's kind of like a rocket finally shedding its heavy booster stage, right?
Oh, I like that.
Yeah, like once those initial heavy tenant incentives expire and fall away, The REIT just hits pure cash flow velocity.
That is exactly how it functions mechanically.
And when I look at their current situation, I essentially see this massive shadow skyscraper.
A shadow skyscraper.
Yeah. Think about what they have sitting on their balance sheet right now. $39 million in signed but not yet commenced leases, just waiting in the wings.
Right, the contractual backlog.
Exactly.
Yeah.
In physical terms, that represents 570 basis points of occupancy.
Yeah.
It is basically an invisible, fully leased office tower that Piedmont has legally secured.
That's a great way to visualize it. It's beautiful on paper, but as you said, it's generating zero cash today.
Right. But it's the entire key to their raised guidance, isn't it?
It absolutely is. Management isn't just out there guessing about the macroeconomic weather in October or November.
No, they are looking at $39 million worth of signed contracts sitting in their desk drawer.
Exactly. As those leases finally reach their commencement dates, and as the current free rent periods burn off, that backlog mathematically converts into real income.
Which makes the back half of 2026 basically look de-risked from an operational standpoint.
Structurally, yes. They have incredible visibility.
But, it's easy to look at a 32% accrual jump and just assume Piedmont has this magic touch everywhere they go.
Oh, for sure. And commercial real estate definitely does not work like that. It's incredibly localized.
Right. We pull back and look at the map. This isn't really a nationwide win for them. This is, at its core, an Atlanta story.
The regional divergence is actually really stark. Total Q2 net operating income hit $88.1 million.
And how much of that was just Atlanta?
Atlanta alone generated $29.7 million of that total. It is the undisputed heavyweight of their portfolio right now.
Wow. So roughly a third of their total NOI is coming from a single metropolitan area.
Yeah, it's massively concentrated.
What specific mechanisms are driving that kind of hyper-concentration there?
The data points pretty clearly to two major flagship projects, 1155 Perimeter Center West and Galleria on the Park.
Okay, so what makes those two properties so special?
Well, they aren't just standard run-of-the-mill office buildings. They are heavily amenitized premium Class A assets.
Right, they're perfectly positioned to capture that flight to quality trend we keep seeing.
Exactly. Companies are finally realizing that if they want to mandate their employees back to the office actually has to be worth commuting to.
Yeah, nobody wants to commute to a sterile, boring cubicle farm anymore.
Exactly. And Orlando is actually showing very similar momentum for them.
Oh, really? How did Orlando do this quarter?
It generated $11.7 million in NOI, which was heavily boosted by lease commencements at 501 West Church and 200 South Orange.
Ah, right. The project they call the Exchange.
Yeah, that's the one.
But, okay, we really need to seriously debate this portfolio concentration for a second. You have Atlanta carrying a third of the weight. You have Orlando pulling heavy duty.
Right.
Is Piedmont exposing itself to massive singular market risk here? Or is this just the Sunbelt migration thesis function exactly as they designed it?
I mean, concentrating a third of your revenue in one single city is undeniably a measurable risk.
Right, because what if the local Atlanta economy stumbles?
Exactly. Or what if the regional tax incentives for corporate relocations suddenly dry up? Piedmont's bottom line would take a direct, massive hit.
Yeah.
But framing it purely as a risk kind of ignores their deliberate strategy. Piedmont has explicitly built a moat around premium Sunbelt assets.
Because for the last 5 years, all the corporate relocations and population shifts have heavily favored that region.
Right. The favorable tax environments down there are a huge draw.
But a moat in a growing region is great, right up until the growth stalls. And the Sunbelt isn't just one big monolith.
No, definitely not.
Dallas is right in the heart of that Sunbelt thesis, and Dallas is standing out here as a notable laggard.
Yeah, Dallas definitely struggled. They saw their NOI drop to $16.1 million this quarter.
What was the primary culprit there?
It was mostly due to decreased occupancy at their Galleria Towers project.
Okay, so a specific asset dragging down the regional average.
Yeah. They did manage to offset the bleeding slightly with a few new tenant starts, but Dallas proves your point perfectly.
Right, you cannot simply buy a shiny building south of the Mason-Dixon line and just expect automatic 13% cash spreads.
Exactly. The micro-market dynamics, like the supply of competing buildings or hyper-local corporate downsizing, require constant localized management.
It just reinforces that Class A office space is hand-to-hand combat on a block-by-block level.
It really is.
But look, winning the leasing game in Atlanta is crucial, sure. But commercial real estate is ultimately a leveraged financial gain.
Oh, 100%. Debt is everything.
Exactly. So we have to pivot from their operational wins to how they are actually funding this portfolio. Because strong leasing means literally nothing if the debt profile suffocates the cash flow.
Very true. And looking at the balance sheet, the critical metric to watch is their ratio of net principal debt to core EBITDA.
And where is that sitting right now?
Currently, it sits at 7.2 times.
Okay, just to provide some baseline context for you listening. Core EBITDA measures earnings before interest, taxes, depreciation, and amortization. It's basically a proxy for the raw cash generated by the business. So a 7.2 times leverage ratio means it would take them over 7 years of their current earnings to pay off all their debt. And that's assuming earnings stayed completely flat and they used every single penny for debt service.
Which is a heavy load. I mean, in the zero interest rate environment of 2021, 7.2 times was incredibly manageable.
Right, because money was basically free.
Exactly. But in today's high-rate environment, carrying that much leverage requires some really precise financial engineering.
Which is exactly what management executed this quarter.
Yeah, they went in and amended their 2024 unsecured term loan.
What were the actual terms of the amendment?
They upsized the principal amount from $325 million up to $400 million, and they pushed the maturity date all the way out to May of 2031.
Okay, wait. Where did the extra $75 million in cash from that upsize go?
Well, they took the net proceeds from that new $400 million term loan, and they used it to completely repay the outstanding balance on their 2022 unsecured line of credit.
The one that originally had a capacity of $600 million.
That's the one.
Let's really break down the mechanics of what they just did there, because this isn't just some boring paper shuffling exercise.
No, it's a huge strategic move.
A corporate line of credit operates a lot like a massive floating rate credit card. Back in 2022, when they opened it, borrowing costs were significantly lower.
Right, the rates were manageable.
But as rates have skyrocketed, the interest on that floating rate debt begins to just erode operating cash flow month after month after month.
Exactly. The interest burden just grows.
So by taking out a larger term loan and pushing the maturity to 2031, they essentially took a massive, volatile credit card balance and rolled it into a fixed-rate, longer-term mortgage.
That is the exact mechanical advantage. I mean, yes, it cost them some capital to execute that amendment, but it locks in their monthly debt service payments.
It's like trying to change tires on a moving car while the interest rate terrain is incredibly bumpy. They needed stability.
Yeah, it removes the immediate threat of a near-term maturity wall, and it totally insulates them from the Federal Reserve's short-term rate decisions.
They bought themselves 5 years of breathing room.
They did.
And honestly, they desperately need it because the macro risks threatening their whole thesis are not theoretical anymore.
No, not at all. If you read through the risk factors outlined in their 10Q filing, they explicitly cite development and construction delays.
Right. They put a heavy emphasis on supply chain disruptions.
Exactly, because when you are signing leases with top-tier corporate tenants, those tenants demand highly customized, high-end build-outs before they even move in.
Right. They want the premium finishes.
Yeah. So if a supply chain issue delays the delivery of, like, specialized HVAC units or custom architectural glass.
Piedmont cannot hand over the keys.
Exactly. And if they can't hand over the keys, the commencement date is pushed back.
Which means the shadow skyscraper we talked about earlier, that $39 million in signed leases, just stays in the dark.
Right. The cash flow is delayed entirely.
But there is a much larger secular risk that management highlighted in the filing. And it goes way beyond just supply chain hiccups.
No, you're talking about the tech displacement.
Yeah. They explicitly call out artificial intelligence, machine learning, and virtual meeting platforms as factors that could permanently alter how commercial office space is used.
I mean, it is the existential threat to the entire asset class right now.
Right. Piedmont's bull case is that their Piedmont places, those heavily amenitized premium physical spaces, are insulated.
Because companies will always need centralized hubs to build culture, right? Even if they shrink their overall square footage.
Yeah, that's the argument. But I look at this as a massive collision of timelines.
How so?
Well, Piedmont is out there signing these 7, 10, maybe 12-year leases, right? Legally locking tenants into these massive physical footprints.
Yeah.
But the technological landscape is evolving on like a 12 to 18-month cycle.
That is a huge mismatch.
Yeah, exactly. Yeah. Think about a regional law firm signing a lease today for 3 whole floors. By 2030, if AI can handle 60% of their document discovery, they need significantly fewer paralegals and junior associates.
Right.
So when that long-term lease finally comes up for renewal, they're absolutely not going to keep 3 floors.
Yeah, the bear case is that technological efficiency just aggressively outpaces the duration of these long-term leases.
Right.
If companies can operate with 40% less headcount due to AI efficiencies, the sheer volume of square footage required across the broader economy just shrinks.
Which basically means Piedmont's only real path forward is cannibalizing their competitors.
Exactly. They have to constantly convince tenants who are leaving older Class B buildings to upgrade into Piedmont's Class A buildings.
Just to maintain their current occupancy levels.
Right. And their 14% cash leasing spreads suggest they are currently winning that exact battle.
Yeah, they're successfully capturing that flight to quality.
But the acknowledgement in the 10Q is a really sober admission from management that this long-term war against technological displacement is far from over.
So bringing it all together, we are looking at a highly complex machine functioning at peak efficiency today.
They really are firing on all cylinders right now.
Yeah, they are posting record net effective rents at $25.56. They are driving huge 9% cash NOI growth by methodically burning off free rent.
And they have built a regional fortress in Atlanta that is totally validating their Sunbelt strategy, even with Dallas requiring some heavy lifting.
Plus, they just executed that crucial balance sheet maneuver, trading a volatile floating rate credit line for fixed rate stability all the way out to 2031.
They have engineered a very sturdy bridge to the near future.
Right.
The operational success buys them time, and the debt restructuring ensures they have the capital flexibility to navigate a turbulent macro environment.
But I want to leave you with a final thought to mull over as you digest this earnings print. We've built this entire narrative today around that shadow skyscraper.
Right, the $39 million in signed leases just waiting to commence.
Exactly. We framed it as a de-risking mechanism for the back half of the year. But here is the critical vulnerability in commercial real estate.
What's that?
What happens if a sudden macroeconomic shock or recession hits before those tenants physically occupy the space?
Oh, yeah, a lease contract is a powerful legal document, but it cannot generate cash if the underlying business fails.
Exactly. That massive revenue buffer is only as ironclad as the solvency of the tenants who signed it.
Right. If a tenant's business model is disrupted before they can even move in, that invisible cash flow just vanishes.
Yep. Until the physical keys are handed over and the first check clears the bank, Piedmont is still acutely exposed to the broader economy. Make sure you follow the show for your daily earnings coverage.